U.S. stocks rallied this week despite different central bank decisions on the U.S., Europe, and China within just 24 hours. All three went different ways. The U.S. kept rates unchanged. The Eurozone raised. China cut both short and medium-term rates. The U.S. has been surprisingly resilient, even with stubbornly high inflation. China has very little inflation, but needs to boost the recovery. And the Eurozone has just slipped into a technical recession, though prices continue to go up. And for more on how this affected the markets this week, John Terrett at the NYSE.
On Wall Street, with CPI and PPI coming in tamer than expected, and the Federal Reserve doing what we thought it would do, pausing its 14-month interest rate hiking campaign in June, but with a stern warning there could still be 2 more 25 basis point increase hikes before the end of the year if needs be. Of course, the ECB, the European Central Bank, hiked its interest rates by 25 basis points, taking them to the highest in almost 20 years. China cut, on the other hand. And a story of little consequence but great interest. Bud Light, no longer America's most popular beer. It's been taken over by a Mexican rival. On the markets, there was plenty of green on the screen for most of the Friday, but then it all just evaporated. It was what they call quadruple witching day. Options contracts, futures contracts, running out and needed to be renewed. It's a regular thing. Well, it happened on Friday, and in the end, the Dow was down 1/3 of 1%, 108 points to stand at 34,300. The Nasdaq was down 0.7 of 1%, 93 points. S&P 500 down by 1.3%, 16 points to stand at 44,009. Well above the bear market territory it had been in. For the week, all three of them in the green. And in the week ahead, the stock exchanges closed on Monday for the relatively new holiday of Juneteenth in America, which honors and commemorates the ending of slavery in Texas and around the country. On Tuesday, earnings from FedEx, and on Thursday, earnings from BlackBerry out of Canada, and also one of the gun makers here, Smith & Wesson. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more sense of these markets, Arthur Dong joins us, teaching professor at Georgetown University's School of Business there. Welcome back to the show. Good to see you, Arthur.
Thanks, Phil. Always great to be on.
It's wonderful to have you on because we're going to ask you how to explain how 3 different parts of the world do 3 different types of rate cuts. Traditionally, the world generally moves in the same direction. China cut, the U.S. stayed the same, and then Europe raised. And I get it. You know, some folks are a little faster than others, and we're seeing different levels of inflation. Does that suffice the explanation?
Yeah, so we have what's unfolding is a tale of 3 different economies. Certainly China, the United States, and the EU all confronting dissimilar circumstances. Now, in the United States, you know, we are, has been shown that the U.S. consumer has been incredibly resilient, and the demand side of the U.S. economy has been, in a sense, you know, pretty well supported. And the most recent news about the CPI, as well as the PPI, which is the Producer Price Index, both of them coming in under forecast, has given investors a great deal of confidence that the United States is headed towards a soft landing. Now, China is a different circumstance. They are still, you know, dealing with the post-pandemic rebound, and their, you know, global demand has sort of, you know, abated, and therefore the export component of China's economy is starting to, you know, withdraw a bit, as well as other domestic problems, including the real estate industry within China, as well as high youth unemployment. So different set of circumstances facing China, thus inspiring the People's Bank of China to lower interest rates.
So sometimes I wonder, Professor, that if policymakers just did nothing, right? We just stopped doing all policy decisions right now, if time would heal some of the wounds of the past. In other words, eventually the real estate market will heal itself. It just takes time. In the U.S., inflation would go down. Rates are relatively higher than where they were over the past couple of years, I think somewhere around 5%. And over in Europe, yes, they have an inflation problem, but raising rates today, it may not necessarily solve the inflation problem of tomorrow, because they have a special situation over there as well. Are we becoming too reliant on government and policymakers to, for lack of a better word, control the economy?
I believe that policymakers today, particularly on the monetary and fiscal side of the equation, have much better understanding and much more tools available at their disposal when compared to, let's say, the Great Depression, or let's say, a half century or more ago. And so that being said, I think, policymakers, there's a general view that, yes, governmental intervention where necessary to arrest inflation and to keep the economy on track is perhaps a wise thing to do. But, there are consequences to, rapid increases in interest rates, as we've seen a 500 basis point increase year over year.
It's historic. I mean, I've never seen it. And as for the rest of normal investors out there, there's an attitude or a thought that with this pause by the Fed that they're done. But then the Fed came out and said that, well, it's temporary pause or it's a skip, and we might consider rate hikes down the road depending on the data, because we're worried that inflation might jump back up again. Do you think that they're being honest when they pause and they say, well, we might raise? The message they're really sending to the market is don't celebrate quite yet, but the markets are like calling their bluff because we've rallied the past few days since the rate doing nothing.
Yeah, the point you bring up, Phil, is an important one, because there are market participants who believe that this is a head fake. In other words, Jerome Powell just said just a few days ago that we should expect further rate increases in July and August. But the market sentiment seems to be in the opposite direction, that the tapering has begun and that further rate increases can only imperil the U.S. economy in terms of increasing unemployment. And that's a particularly hazardous thing to do coming into an election year.
Right, hazardous it is. Now, over in Europe, they obviously have the crisis in Ukraine. That caused a ton of consternation over the past 15 or 16 months or so. And I think some people are surprised that Europe isn't quite getting the handle on inflation that we thought they were. Now, granted, they also started a little bit later than the U.S. in terms of pumping rates higher. Why haven't we seen more progress when it comes to fighting inflation, specifically in Europe?
I think they're confronting a higher degree of energy dependence than the United States. The United States certainly is more independent when it comes to sources of energy. And in Europe, they're highly dependent on other sources outside of their borders. And thus, that's one of the contributing factors to the inflationary picture that is currently surrounding Europe.
All right, Professor. Thank you very much. Really appreciate your analysis on the tale of 3 different regions around the world. Have a good weekend, sir.
Thanks, Phil.